our special segment, NDTV Profit Deep Dive. Today we put the spotlight on RBL Bank and take a closer look at what's not working, along with some monitorables, key monitorables for the bank. Hiral Johnson with the detailed analysis. Hiral, good morning.
Good morning. So clearly, if you see in terms of RBL Bank, there are a couple of factors which are not working. But what we need to wait and watch and see is whether there will be a turnaround in place from here or not. Let's quickly look at the key concerns. Firstly, the loan growth, asset quality and margins. These three aspects have been a concern with regards to where RBL Bank goes. The loan growth has been lower at around 15% versus a guidance that was given at for about 18 to 20%. So it does not seem that the bank will be meeting the guidance as well. Secondly, the collection efficiency has remained below the 98% mark. Usually 98% is the standard that the banks want to follow. So that has been below. And if you see in terms of the stock, that's down nearly 9% in the last 5 trading sessions. Overall, if you go to see in terms of the performance in FY25 so far, the stock is down almost 40%. So again, the wealth has been eroding. Now, if you talk about the deterioration that we've seen in terms of the asset quality as well, from 3.22% in the gross NPAs, it's actually gone, it's now at 2.88. So it had come down to 2.65 and again risen to 2.88. And if you talk about the unsecured portfolio, that consists almost 55% of the retail book and 41% of the overall book with regards to where the loan book goes. Now, moving on, the special mention accounts, that's the SME accounts, that is something which is actually indicating a concerning trend, because SMA 0, that's the loans which are overdue between 0 to 30 days, that stands at around 3.1%. Apart from that, the 30 to 60 days overdues at around 2.45%, that's SMA 1. And if you talk about the special mention accounts, which is SMA 2, which is 60 to 90 days overdue, that is at around 1.5%. So all of these parameters are at the higher end. Moving on, slippages have gone up, right? So from 0.75%, it's gone up to almost 1.19 in the second quarter of FY25. So that is a major concern, because of which higher provisioning on higher slippages we've seen in credit cards and microfinance. So these are the two segments that are creating this kind of stress. If you see in terms of the provisions, in the first quarter, 266 crores, that's in FY24. It's now at 618. If you see on a sequential basis, the provisions have actually doubled, but it also includes a 252 crore contingent provision that is still held by the bank. And I'm talking about the last quarter that was reported. Moving away from the provisions, if you see in terms of the credit card and the microfinance challenges that we've been speaking about, that is weighing on the net interest margins, because from a 5.54, it did manage to go up to 5.67 in the first quarter of FY25. And from there, it's again dipped down to 5.04. So that's what the pressure has been building up in terms of where the net interest margins are concerned. Moving from there on, the credit costs that have been higher on the microfinance portfolio, and they're saying that that is expected to move up as well. Secondly, if you talk about the credit costs, they have increased during FY24 to almost 1.4% versus a 0.92% in FY23. And to this, the contingency buffer on the credit cards, microfinance and the personal loans has gone up by almost around 100 basis points. Moving on, all of this weighing on profitability, because if you see the profitability, the curve which was upwards from 288 crores to 372 crores till the first quarter of FY25 has come down to 223 crores in the second quarter of FY25. With taking all of this into consideration now, what is it that we will be watching out for? One, will RBL Bank continue to prioritize return on assets over growth? Because these are the two parameters that they are looking at. If ROA has to be looked at, growth will be compromised. Secondly, the loan growth rate, because the guidance is 18 to 20%. They're currently somewhere in that 15% mark. So what are they going to do with regards to where the guidance goes? And the bank's ability to keep the slippages low, that again becomes a key from here on, because the provisioning has been increasing. So clearly, if you go to see, yes, there are a lot of concerns that we are seeing, the stress specifically with regards to where microfinance as well as the credit card business goes. But whether the bank is able to tide all of this, that will remain key.